Forward contract designated as fair value hedge. Assume that X & Co decides not to designate the forward contract as a cash flow hedge, but instead elects to treat it as a fair value hedge. In that case, the gain or loss on the forward contract is taken directly to net income and there is no separate amortization of the original discount on the forward contract. Year 1 Journal Entries Forward Contract designated as a fair value hedge. Table Summary, a journal entry with a date at the left on the first row, the debit row, one credit row, and an explanation line. 12/1/Y1. Accounts receivable, Euro. $1,500,000. Sales. $1,500,000. To record the sale and €1,000,000 account receivable at the spot rate of $1.50, Step 1 in. Exhibit 6.4. There is no formal entry for the forward contract, Step 2 in. Exhibit 6.4. A memorandum would be prepared designating the forward contract as a hedge of the risk of changes in the fair value of the foreign currency account receivable resulting from changes in the US dollar-euro exchange rate. Page 228. Table Summary, 2 journal entries with a date at the left on the first row and each journal entry having one debit row, one credit row, and an explanation line. 12/31/Y1. Accounts receivable, Euro. $10,000. Foreign exchange gain. $10,000. To adjust the value of the euro receivable to the new spot rate of $1.51 and record a foreign exchange gain resulting from the appreciation of the euro since December 1. Loss on forward contract. $10,783. Forward contract. $10,783. To record the forward contract as a liability at its fair value of $10,783 and record a forward contract loss for the change in the fair value of the forward contract since December 1. The impact on Year 1 net income is. Table Summary, there are 2 amount columns, and the second and third rows have amounts in the first column only, while the other rows have amounts only in the second column. Sales. $1,500,000. Foreign exchange gain. $10,000. Loss on forward contract. $10,783. Net gain, loss. $783. Impact on net income. $1,499,217. The effect on the December 31, Year 1, balance sheet is. Table Summary, there are 2 side-by-side sections to the table with assets at the left having only one row entry. Assets. Liabilities and stockholders' equity. Accounts receivable, Euro. $1,510,000. Forward contract. $10,783. Retained earnings. $1,499,217. $1,510,000. Year 2 journal entries forward contract designated as a fair value hedge. Table Summary, 4 journal entries all having one debit row, one credit row, the fourth entry has 2 credits, and an explanation line. The 3/1/Y2 date at the left in the first row of the table applies to all journal entries. 3/1/Y2. Foreign exchange loss. $30,000. Accounts receivable, Euro. $30,000. To adjust the value of the euro receivable to the new spot rate of $1.48 and record a foreign exchange loss resulting from the depreciation of the euro since December 31st. Forward contract $15,783. Gain on forward contract $15,783. To adjust the carrying value of the forward contract to its current fair value of $5,000 and record a forward contract gain for the change in the fair value since December 31st. Foreign currency, Euro. $1,480,000. Accounts receivable, Euro. $1,480,000. To record receipt of 1 million euros from the Spanish customer as an asset at the spot rate of $1.48, Step 3 in Exhibit 6.4. Cash. $1,485,000. Foreign currency, Euro. $1,480,000. Forward contract. 5,000. To record settlement of the forward contract, that is, record receipt of $1,485,000 in exchange for delivery of 1 million euros and remove the forward contract from the accounts, steps 4 and 5 in Exhibit 6.4. The impact on year 2 net income is as follows. Foreign exchange loss. $30,000. Gain on forward contract. 15,783. Impact on net income. $14,217. The net effect on the balance sheet for the 2 years is an increase in cash of $1,485,000 with a corresponding increase in retained earnings of $1,485,000. Under fair value hedge accounting, the original forward contract discount is not amortized systematically over the life of the contract. Instead, it is recognized in income as the difference between the foreign exchange gain, loss, on the account receivable and the gain, loss, on the forward contract, that is, $783, in year 1 and $14,217, in year 2. The net impact on net income over the 2 years is $15,000, which reflects the cost of extending credit to the Spanish customer. The net gain on forward contract of $5,000, $10,783 loss in year 1 and $15,783 gain in year 2, reflects the net benefit, that is, the increase in cash inflow from Exxon's decision to hedge the euro receivable. If the forward contract is not designated as a hedging instrument, the accounting is the same as for a fair value hedge of a foreign currency denominated asset or liability. Changes in the fair value of the forward contract are immediately recognized in net income.